Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Allie Canal. Let's get to the three things you need to know today. First up, the rally in U.S. stocks fading following the Fed's Jackson Hole Symposium. The Dow Jones closed out at a record high after dovish comments from Fed Chair Jerome Powell sparked a cross-asset rally. Investors now betting that the Federal Reserve will cut interest rates at its September meeting, but there are still a slew of economic readings between now and the FOMC that could change the Fed's outlook. Plus, the next big market catalyst coming this week, NVIDIA earnings. The AI chip giant will report results on Wednesday after the market close. Those numbers from the world's most valuable company will be closely watched following the recent rally in mega-cap tech stocks. Any disappointment there could derail the artificial intelligence trade at large. And an $18 billion deal in the beverage space. Keurig Dr Pepper has agreed to buy JDE Peet to bolster its struggling coffee business. The company citing tariffs and inflation for roughly flat U.S. coffee sales in the second quarter. Once the deal is complete, Keurig Dr Pepper plans to separate its coffee and beverage units into two independent U.S.-listed companies. Let's get a quick check on U.S. stock futures. We're seeing futures underwater a bit. The Dow is off around 150 points. The S&P and the NASDAQ also trading in the red following that huge rally that we saw on Friday after Fed Chair Jerome Powell sparked a bit more dovish optimism when it comes to the future of interest rate cuts. So let's dig in to those top stories of the day. Like we were just discussing, stocks are pulling back a bit after rallying on rate cut hopes. All eyes now turn to the Fed's preferred inflation gauge that's due on Friday. And then we have NVIDIA reporting second quarter earnings this week, plus what to expect from retailers as more earnings roll in. Joining me now is senior reporter Brooke DiPalma, live at the NASDAQ, senior markets reporter Inez Frey, and tech editor Dan Howley. Guys, thanks for being here. And Brooke, I want to start with you on some of this recent market optimism. Jefferies just boosted its S&P price target to 6,600. That's up from 1,000 points previously. So what's behind that call?
Yeah, largely what Jefferies is citing, joining the likes of UBS, Citigroup, and HSBC to raise their S&P 500 targets. They cited robust second quarter earnings. That's what's driving the momentum of raising their target. They also cited easing concerns about the health of the U.S. economy. Of course, heading into this year, there was so much uncertainty around how exactly tariffs would impact both prices as well as consumer demand. But right now, Jefferies raising that target up from the previous target that they had set out from 5,600. They were one of the only financial firms to have that target below 6,000. So of course now the S&P 500 trading around 6,000, nearly 500. Right now they're raising their target to really equate to what the rally that we've seen over the summer.
And Brooke, Jefferies is not alone. We've seen other banks, UBS, Citi, HSBC, all boosting their respective targets. So a lot of optimism on the street. But considering what we could see with that PCE report due later this week, what are economists expecting and how could that derail a lot of this optimism if it does come in hot?
Yeah, well, right now, the PCE is expected to come in higher than previous months. And right now, economists, based upon Bloomberg consensus data, are expecting PCE to increase about 2.9%. That's the consensus right now. And largely, there's a debate on the street that if this report comes in hotter than expected, then that could signal that we're seeing persistent inflation. That is certainly a concern of the Fed right now. And whether or not that actually materializes as an ongoing inflation problem is what exactly the Fed will be looking at. If that is, then that could cause the Fed to lean into more of a cautious tone after they striked optimism among the street that they would cut interest rates based upon their second dual mandate, of course, persistent inflation, and then maximum employment is also on the table. And that's what they really focused on Friday. Now, if we see that preferred inflation gauge PCE coming hotter than expected, that once again could strike a cautious tone on the street and lower the likelihood of an interest rate cut in September.
Also on the minds of investors, though, beyond just PCE, is NVIDIA earnings. And Dan, obviously, such huge expectations on the heels of this market rally. What are you watching out for?
Yeah, obviously we want to see what the whether or not they beat and raise. That's been kind of something that they've been known to do in the past. I think a lot of times after the earnings, we see a little dip in Nvidia's stock price. I think it's just based on the kind of overhyped expectations to a degree. People looking for those huge gains year over year that they had seen in the onset of kind of the AI explosion. But obviously, one of the big things here is going to be data center, as well as how much of that data center revenue comes from hyperscalers. They say around 50%, little less than 50% of that revenue comes from those huge companies, the Microsofts, the Googles of the world. And so we want to see where that is landing now. Jensen Huang, CEO, has been pushing the idea of sovereign AI, which is countries building out their own AI infrastructure. I want to see if that's kind of helping to fuel some of the data center growth, or if it's still really dependent on those hyperscalers. And then the other thing, obviously, is going to be China outlook. They had originally not been allowed to sell their AI chips, the H20, into China in April. President Trump turned that around in July and then said that they were going to add a 15% or take a 15% cut of those sales. So we just have to see if we get an outlook for Q3 on China, or if they're going to hold off on that for now and just give us a standard outlook or none for China or revenue.
And Dan, is that the biggest risk in your view, considering we saw those reports that China might not purchase those new H20 chips? And if we don't see that guidance, what that could mean for shares?
Yeah, I think that's something that, investors are absolutely looking at. But it's worth noting that, when the April announcement came, we had seen shares fall. And then analysts were basically saying, look, now there's this, unknown has been excised from the outlook. We know exactly what we're going to be getting as far as where revenue comes from. And so then shares rose again. Then President Trump had allowed the company to sell the chips into China, and shares rose on that. So there's going to be maybe some bit of up and down when it comes to the stock price if there's an issue with China outlook, or if they just don't give that to us for the quarter. But I don't think that that's going to be the biggest driver. It's really going to be the amount of year-over-year growth and what they see as far as overall outlook when it comes to revenue.
And we were just looking at a year-to-date chart. NVIDIA shares are up over 30% so far in 2025. And speaking of other assets on the move, crypto stocks. And Inez, you've been tracking this space closely. We just saw Ethereum touch a record high over the weekend. I mean, is this all just a risk on trade? What else is helping boost this asset class?
Look, as far as Ethereum's concerned, it is up 90% over the last 2 months. It has certainly also outperformed Bitcoin year to date, because Bitcoin is up 19% year to date. Ethereum is up at 39%. And on Friday, we really saw crypto surging after Fed Powell's speech, because it was more dovish really than what the markets had been anticipating. And this was definitely a risk-on environment for all assets. But look, the dollar moved lower, and so that was also very positive for crypto in general. The question is whether the recent rally that we've seen is sustainable or not. You have Wall Street analysts that cover this space that are saying that this is sustainable because you have global liquidity that is up, and you have this tokenization trend and corporate treasuries. Those are all contributing to this rally that we've seen in crypto.
And Inez, how are we seeing this spill over into names like Coinbase and some of those crypto adjacent plays like stablecoins as well?
Yeah, stablecoins has been the theme this year, and that has been because of the Genius Act that was passed. And so you saw Circle that had a hot IPO in June, and that stock has done very well since the IPO. It's been volatile, but nonetheless, Circle is the pure play, so to speak, when it comes to stablecoins. The other stablecoin issuer that you have is Tether, but that's privately owned. And all of this is sort of fueling the entire crypto space, because you have Circle that has a partnership with Coinbase, so it shares part of its revenue with Coinbase, so that's positive for Coinbase. And then you have stable coins, which are the digital assets that are backed by the US dollar, and those are bullish for the entire market. So you have T-bills that are treasuries that are also being bought because of the issuance of stable coins. So all of this on the heels of the Genius Act Act that was passed into laws that is positive for the stablecoin issuers, and it's positive for also companies connected to stablecoins as well.
And finally, Brooke, we'll also hear from Kohl's, Best Buy, Dollar General this week. What are you watching as we round out the bulk of these retail earnings?
Yeah, well, certainly we're getting an inside look at the state of the U.S. consumer, not just from the companies that you had mentioned, but also in addition from Ulta, Gap, and Abercrombie and Fitch. And Kohl's will give us a good insight on how exactly the value-conscious consumer is doing, especially in this back-to-school season. We also expect to hear from Best Buy the potential implications of those tariffs on the electronic industry. We do know that right now, same-store sales growth strength is expected in entertainment as well as computing and mobile phones. We know that they had success over that Nintendo Switch launch earlier this summer. Also, Dollar General. That'll be interesting to hear from them how exactly the low-income consumer is performing right now. We do know that a majority of their sales are consumables, those key grocery items that consumers are really turning towards right now. And so lots of puts and takes that we'll get to hear about how exactly the U.S. consumer is holding up in this environment.
Yes, a lot coming down the pipeline this week. Brooke, Inez, Dan, thank you so much. Keurig Dr Pepper plans to buy Dutch-based JDE Peet in an all-cash deal worth more than $18 billion. Once the merger is completed, the beverage giant plans to split into two U.S.-listed companies. Joining us with the details, Yahoo Finance's Brooke DiPalma is back with us. So, Brooke, walk us through the details of this deal. What do we know so far, and how are investors reacting?
Yeah, well, certainly JDE Peet getting bought out for a premium, and you see that stock rising on this momentum of this announced. This deal is assumed to close in the first half of 2026, and then in the second half of 2026, we'll see this company get split out into those two that they mentioned, the Global Coffee Co. and then the Beverage Co. Once again, that's set to be two publicly listed companies here in the U.S. And what we're hearing from the call this morning is that this is the opportunity for them to have the largest global pure play coffee brand. And what we're also hearing is this intention for both of these companies to list as IPOs. If you take a look underneath the hood about what exactly these brands will consist of, we know that right now that Global Coffee Company is expected to have JDE Peet's. It's also expected to have other coffee brands like Green Mountain as well as Keurig. Of course, they are known and really Keurig, those K-Cups, etc., that they're really known for. Also important to note that this comes at a time where the U.S. coffee volume for Keurig Dr Pepper is under pressure. We do know that volume is expected to come in lower yet again, down nearly 3.5% in the third quarter. And then you take a look on the flip side of what exactly that Beverage Co. will consist of, including names like Snapple, Dr Pepper, Canada Dry, A&W, Mott's, but also two key other growth brands, and that's the energy drinks that they have in their portfolio, C3 and Ghost. And right now there's a call underway with investors, and they're certainly weighing in on the potential of this being a major growth portfolio in that Beverage Co. And certainly remains to be seen how exactly this plays out. But it comes after the company announced a merger back in 2018 of both Keurig, Green Mountain. They acquired Dr Pepper, and so this is the unraveling of that deal.
And Brooke, we know the coffee wars have been brewing for some time now, no pun intended there, but how does this play in to the larger landscape, especially as Starbucks is in the midst of its turnaround plan? And it does feel like we've seen more M&A across the food and beverage space at large.
Allie, this is a landscape that is largely very quiet, and we've heard so much noise over the past year within food and beverage, from PepsiCo acquiring Poppi. We also heard from the potential split of Kraft Heinz into two separate companies as well, and also a few years ago, and both those brands now getting bought out separately, is the split of Kellanova into Kellogg's into Kellanova and WK Kellogg. And what I've heard from analysts, a story that I wrote back in the end of July, was that we're hearing so much noise as these companies are really taking a second look at their portfolio because their core businesses are underperforming. That's certainly what we're seeing right now with Keurig Dr Pepper's latest announcement.
Brooke, thank you so much. Coming up, we count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We're watching Intel, Wayfair, and Ørsted. First up, Intel. Shares are extending gains after the U.S. government took a 10% stake in the company. Both Intel and the president confirming the stake, part of which will be funded by grants awarded to the company under the CHIPS and Science Act. Another $3.2 billion will be awarded to the company as part of the Defense Department's Secure Enclave program, which funds semiconductor manufacturing in the U.S. Next, Wayfair, RH, and Arhaus. The furniture maker is falling today after President Trump announced a, quote, major tariff investigation on furniture coming into the U.S. The president says within the next 50 days, the investigation will be completed and furniture coming from other countries into the U.S. will be tariffed at a rate yet to be determined. Finally, Ørsted, the Danish wind farm company, seeing its shares hit a record low. The drop comes after the Trump administration blocked construction of its almost finished offshore wind farm. The company says it will comply with the U.S. order and that it's considering options to resolve the issue and press ahead with construction. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, this Friday, investors will get the latest read on the U.S. economy with PCE data, the Fed's preferred gauge of inflation. It's one of several data releases between now and the FOMC's September meeting, where the street largely expects officials to cut rates. Brian Vendig, MJP Wealth Advisors Chief Investment Officer, as well as Max Wasserman, Miramar Capital Co-founder Senior Portfolio Manager, join us on set. Thank you both so much for being here. So, Brian, let's start with you here. Futures a bit muted today after that massive rally we saw on Friday. Were markets a little too optimistic? Did we overreact to Powell's dovish tone?
Well, Allie, good morning. I think going into Friday, markets actually were hedging for more of a hawkish tone. And when we heard from the Fed that they may revise policy moving forward, I think that's what sparked the risk on rally. And also, from a standpoint of taking a look at quality of earnings over the course of the quarter, we really saw some significant beats year over year where analysts were expecting about 5 to 6% profit growth, and we actually saw 12% so far. Now, we know we have big earnings on the outlook, the mother of all earnings report on Wednesday, and of course, as you said, that PCE gauge, and then next week's jobs report. So I would say these next three data points is really going to be critical for investors to see if these valuations can hold.
And we just saw Jefferies boost its price target. They did specifically cite the earnings growth and momentum that we've seen there. But Max, rate cuts aren't always a good thing, right, when it comes to the why. And sometimes the why is more important than the when. So, when we look at Powell's why, which seems to be a weakening labor market, if we do see those cuts, how should investors be thinking about that?
Well, I think there's two ways to look at it. One is that you have Fed put again. Everybody's expecting the Fed to cut if the economy starts slowing down, and not cut a little bit, but start a monetary easing policy, which would be great for risk assets and for the stock market in general. But why are they cutting? It's because the economy is slowing down. And if you listen to his comments, he said the economy looks to slow down in the second half of the year, and we're on the verge of potential uptick in unemployment. So those aren't good things for earnings, but for financial assets, if the Fed starts a monetary easing policy, that could be a boon for further extension of risk assets.
And Max, you expect the Fed to cut 50 to 75 basis points by year end. Now, if inflation proves sticky, we'll see if that PCE report comes in line, if it comes in hotter than expected. How realistic is that scenario? Defend that take for us.
Well, I think the pressure that the Fed doesn't want to be behind the curve on unemployment, the fact that he shifted unemployment to the conversation now, and growth, where before it was just his benchmark 2% in inflation, I think it's become more of a front center issue for him. So even though I don't believe he should cut interest rates, right, I think inflation is sticky, I think he will by year end from the sheer fact that we see unemployment starting to tick up. If you look at what's happening in college grads, if you look what's happening in the AI effect, we do expect unemployment to tick up in the fourth quarter, and we expect growth to slow down. Now, even though you could have stagflation, which is inflation, with no growth, we think the Fed's not going to tolerate that, especially with the pressure from the White House. And it's not if the Fed's going to cut, it's just when. So I think that's really the debate. And Friday, he gave a lifeline to the people who say he's going to cut. So Whether he cuts on September in the next few weeks, that's going to depend on the data, right? But I think he will cut by year end 50 to 75, and that's what people are betting on.
Now, stocks haven't just been rallying because of the expectation of Fed rate cuts. It's also been about big tech, and we've seen mega cap tech really lead markets higher. There have been signs of rotation, though. Small caps rallying, home builders seeing a lot of intense growth here. Can this market sustain its highs without big tech being the leader? Because I know market rotation's healthy, but sometimes if that comes at the cost of tech, we don't necessarily see that play out in equities.
That's a great point and a great question. I think you have to look at those forward earnings outlooks, because right now tech is about 82% of the total S&P profits based on what's reported thus far year to date. But moving forward on those outlooks, Allie, into the balance of the year into next year, you actually see a little bit of a significant decline in contributions coming from tech and an uplift coming from other areas in that value sector. So if you think about the renewed focus on utilities, power generation, deregulation for financials, as well as a steepening yield curve. Those are good news items. Healthcare needs to participate a little bit, but the other major leader that's helped outside of tech has been industrials. So if you think about the flow through from the tax and fiscal spending and some of these other areas, I think the market is looking for a balance, but at the end of the day, the AI story is not dead. We'll hear what NVIDIA says, of course, on Wednesday, but moving forward, I think it's that renewed investment in AI as well as other areas of the economy, and that's what investors, I think, are hopeful for 2026.
And speaking of tech, Max, you flagged Microsoft, Alphabet, Broadcom as big AI winners. What sets them apart from the pack, and how much exposure should you have to these names that are not NVIDIA?
Sure. I mean, we're dividend growth investors, so we have more of a barbell strategy. So we like those companies. They do pay dividends, and I think you have to have a sprinkle of them. I mean, our portfolios have about 20% in tech, and our biggest investments are in Microsoft, Broadcom, and Google. So we like them, but I think you have to be outside of that area, because I think you're going to max out this valuation expansion. And I think the Fed cutting interest rates will keep that valuation high. But I don't know if you can continue to go 50, 60 times earnings or 40 times earnings with a slowing economy. So we like the other parts of the market. So we do think other areas that look good and have not participated. Healthcare has not participated because of all the political issues that are going on and the new generic drugs coming out. So that's an issue, but we like it. And industrials, keep in mind, the market's going to forward price, right, 6 months out. So if you start getting an easy policy, you may not see it in the earnings this year, but you'll see it in the beginning of the first quarter, especially if the Fed were to become aggressive interest rate cutters. That's the key. You have to look forward 6 months, because that's what the market's going to take. As soon as he cuts a quarter, or even 50 if he did it, the market's going to be looking for another thing. So they're going to be looking for those areas in the market that will expand their earnings based on lower interest rates. But it's a double-edged sword, because you cut the interest rates, right, you're going to lower the value of the dollar, right, which is what the current administration wants. So that's going to have effects. We think energy could catch a bid because a lower dollar does well for oil stocks, just for the fact that it's dominated in dollars.
Well, we will see the results that we get later this week. Brian, Max, thank you so much. Appreciate it.
Thank you.
Coming up in Yahoo Finance, opening bid, our own executive editor, Brian Sazi, joins us now. So, Brian, what's coming up on the show?
Allie, good to see you. We're going to continue the conversation on NVIDIA ahead of its big earnings report midweek. But the top of the show is kicking off with a very important conversation with former Treasury Secretary Larry Summers. Looking forward to that chat.
Yeah, it's going to be great. Can't wait for that. That does it for Morning Brief. Much more ahead on Yahoo Finance.